Hi, all, and thanks for tuning into this very special conversation that we try to do with the Citi think tank almost every quarter. And it's important quarter as well, because if Q2 gave a bit of a surprise, the question to our experts today would be whether Q3 is baking in some of that already or not. And to talk about that, Surendra Goyal, Manish Shukla, Rashi Chopra, as well as Arvind Sharma joining. Gentlemen, sorry, ladies and gentlemen, all of you, thank you so much for joining in. Really appreciate your time. Surendra, can I start off with you? What's your sense of quarter three? Because I read your note, and it brings to forth one of the most important questions that everybody has in mind. Is the rebound already pricing in a stronger quarter three, or do you reckon that we will get to know about it only once the quarter is over?
Sure. Thanks, Neeraj. Thanks for having all of us here. So, see, from a quarter perspective, we are expecting a decent sequential recovery, which is partly due to the fact that the broader economy has been recovering after the lockdown. Okay, so that's one part. And secondly, there was the festive season, which always results in some bit of a sequential uptick. So both those things are kind of resulting in a decent recovery. Now, in terms of the surprise element, I think if you see what drove the surprise last quarter, a big part of that was because of the cost optimization or cost cutting by a lot of corporates across sectors, right? And some of those cost savings may continue, given that things have kind of still continued to be work from home, or in some cases, some of the costs have not come back. Like, for example, in IT, travel costs have not come back and so on. So you could actually see decent trends from a cost perspective continuing. Having said that, will it be a surprise? No, I think the reason why all of us got surprised last quarter was it was after years where we had a decent earnings beat and a consensus EPS upgrade. I don't remember, at least last 5 years, we have not seen an upgrade. So which is where the surprise came in. So to that extent, it cannot be a surprise. You may get slightly better numbers. So far, the trends are pretty healthy. But obviously, the level of surprise will be a lot lower because at least we already saw it playing out last quarter. So I think that is where we are. Trends are quite decent, I would say. And that, as I said, economy opening up and the festive season, both those things are helping the quarterly performance.
So that's from a larger perspective, the positive side, Surendra. The only question that comes to mind is that we are at levels that we are at, which is almost at highs. And there is a re-emergence of some lockdowns, a second virus strain, what have you. And maybe the belief is that the central banks have done the magic that they could in the first time and don't know how much is left in the bank. So could that pose a bit of a problem? Or do you reckon if it's a stronger earnings season, then it will take care of these niggles?
See, on that part, I would think that can impact things with a little bit of a lag. Okay, because if you look at US, Europe, now some of the sectors which are impacted, possibly the biggest impact is on IT services. And there, at least the clients that IT services companies deal with, they have kind of moved to a work from home or whatever distributed model quite well. And which is why IT companies were not impacted at all. So all the large four companies have reported so far, and trends have been pretty decent. So I think the clients which Indian companies cater to, which is the Fortune 1000 customer base, or the Fortune 2000 customer base, they have gotten used to this work from home situation quite well. So I wouldn't expect that to really be a big challenge. What could eventually be a challenge is that there is some impact on demand of the corporates in those countries, right? And that could in turn put some pressure on their spending and so on, but that would come with a bit of a lag. So that is what we need to kind of keep in mind. Near term, I don't think it would be an issue. On the broader question, I think what is important is the market is already at the kind of levels we are talking of, right? Valuations are 2 standard deviation above the 5-year mean. So to that extent, a lot is being priced in already. And what really supported the market was the very high level of FII inflows in November and December. Like $16 billion plus in 2 months is something which is kind of unprecedented, has not happened in a long time for sure, right? So I think flows are important, but the market levels are elevated. And in that context, I think one should be watchful, given that a lot seems to be priced into the market.
Then just one follow-up on that, since it's such an important leg on which the market rests. Of course, November, December also saw countries which didn't have foreign flows also do well. But that notwithstanding, what are client conversations telling you? Are are your clients comfortable putting in money into India at the current valuations and themes that you are telling them to, or are people holding back because of the valuations?
Okay, so definitely there is a bit of caution, I would say, given the valuations of the broader market. Lot of sectors are trading at like 5-year highs or very close to 5-year highs as far as valuations are concerned. So there is definitely caution. Having said that, I would always say that there are 30, 40 stocks in India where there is always interest, and any dips will likely get bought. And out of those, usually 5, 10 stocks are at reasonable valuations, at least in the context of their history. Even today, for example, if you look at it, and again, Manish will talk about it, but if you look at corporate banks, they are still below mean median kind of valuation, right? While the broader market is where it is. And there are pockets like that. So there is interest in select stocks, but I would say there is a bit of caution given that a lot seems to be priced into the market. And see, the flows of 16 billion in 2 months, the reason I'm kind of emphasizing is usually, like if you look at calendar 19, I think it was $14 billion in an entire year, right? So which is the reason I'm emphasizing it's a big number. So those flows have to sustain, without which the market could anyway see some pressure as we go forward.
Also considering the fact that the domestics are not quite supportive of, in terms of flows at least, the way they were maybe in the better part of 2019.
Absolutely.
Yeah, fair point, Surendra. Okay, let me take that cue. Manish, can I come to you? And how are you gauging this quarter three? The index that the space that you so closely track finally did come back to its erstwhile highs late last in the month of December or maybe early Jan. What's your sense about how will the quarter live up?
Sure. So you talked to Surendra about the element of surprise. The element of surprise in the previous quarter, that is the September quarter, was the expectation on very low levels of restructuring. We had gone into that quarter with very high levels of system moratorium. And after the quarterly results, banks indicated that the restructuring is unlikely to be more than 3 to 5%. Since that October, November, we've seen this big rally in financial stocks, even as we speak. But again, as Surendra mentioned, if you take last 12 months, financials as a pack have still underperformed the broader market. So while there are those pockets of valuations like a Kotak Bank or a Bajaj Finance, if you see broader financials, valuations are still much below where they were pre-COVID. Talking specifically for this quarter, I think what the number matters is the restructuring. HDFC Bank reported over the weekend only 0.5% restructuring. So that actually sets the tone well. So for the broader system, restructuring levels are 2% or below. I think that's a very good outcome going into March and beyond in terms of provisioning and credit cost. Because all said and done, while economy is improving and people are talking about growth, as far as December quarter is concerned, it is still largely focused on asset quality for the quarter as well as what goes through for the rest of the year.
So, you reckon what HDFC Bank did, Manish, is something that the others can kind of follow up to? And what in the commentaries are you watching out for the most? I mean, the consensus on HDFC Bank that we reported today from or the on call or the brokerage views as well seem to be pretty sanguine about and pretty bullish about what the company said in the call too. What's your sense about how would the space at large do? And of course, on HDFC Bank too individually.
Yeah, so HDFC Bank throughout COVID in some sense has been an exception, right? So all 3 quarters, bank has reported pretty strong growth, both on assets and liability side. And that kind of shows the strength of the franchise. It was reflected in the lower restructuring numbers as well. But I think even if you take HDFC Bank as an exception and at 0.5% restructuring, at least for the larger banks, numbers probably will not be too much out of whack compared to where HDFC Bank was. Because the big corporate cleanup anyway, which had happened pre-COVID. And retail generally is behaving well as an asset quality. So I think as far as asset quality is concerned, the larger banks will probably be bunched up together. On growth, obviously, HDFC Bank is likely to be an exception, at least as far as December quarter is concerned. Compared to HDFC Bank, we might see slower growth for other banks. But what will be interesting to know is what the banks talk about going forward. Because slowly but steadily, the economy is on the mend. Only debate, if anything, is around the pace of the recovery. But generally, there is agreement that the economy is on the mend. So in terms of credit growth for the March quarter and beyond is quite significant. For example, if you build a 10% odd real GDP growth for next year, that ought to mean pretty decent credit growth for the banking system. So I think commentary on the growth bank-wise is what I would look forward to in the quarter.
Manish, just a quick follow-up there. So again, largely assuming that the color around the whole year is not too different for some of the larger ones. I mean, there could be nuanced differences here and there, but largely all of them sound equally bullish or equally sanguine. Do you believe, or what would your call be? Would some of the, not tier two really, but not the HDFC Kotak variety, but the others, the other retail or corporate facing banks, do you reckon the valuation compels you to maybe give them a slightly more favorable verdict to your clients, or would you still stick to the tried and tested in light of the fact that we might still have some minefields here and there for the banking space?
Sure. At least, I mean, for now, we are advising that investors stick to the larger banks simply because of better comfort on the capital position and better liability franchise. While things are improving, as I said, pace of recovery remains slow. So to that extent, we continue to prefer larger banks over mid-sized banks. I mean, there is some argument that one used to need to play the so-called beta rally if things are on the mend. But I think for that to come back, we will really need to see better commentary from mid-sized banks in terms of growth. I mean, pre-COVID, most of the mid-sized banks were growing faster than the larger banks, and that allowed them to command those premium multiples. Unless we get to that situation again, preferring some of the mid-sized names over larger names looks, I mean, quite difficult. I mean, if you have an ICICI, HDFC, Axis growing in mid-teens, and others probably growing at similar pace, it's really difficult to push the case for smaller over larger, although valuations are definitely in favor of the smaller banks, right? I mean, compared to the historical means, many of the mid-sized banks are trading significantly cheaper than the 5-year mean valuations.
Okay, and I'll come back to you on the NBFCs, Manish, but just a question that I'll squeeze in. You've seen a couple of smaller PSU banks raise some capital as well. And there's a general belief that the PSU story might be turning around. Leave out the larger PSU bank, the largest PSU bank. That I don't want to talk about because there seems to be a consensus there. Do you have any coverage or any thoughts on the non-SBI PSU banks at all?
Yeah. So, I mean, public sector banks, clearly valuations are even in more favor. And if you are in a recovery phase, some of them ought to benefit. Just that we are seeing a consolidation of public sector banks happen, right? I mean, a lot of banks were merged effective April 2020. And because of COVID, integration has not progressed as one would have liked it to be. So that's something which probably be a drag in the near term. And the key variable there is recoveries. I mean, if some of the larger stressed assets which are under IBC get recovered and we see recoveries, earnings could get a boost. In terms of business, the challenge that we really see is for quite a few PSU banks, investments in technology, at least the retail-facing technology, is not as good as some of the private sector banks are. And game in banking in that sense has changed, right? I mean, customers deal with banks more and more digitally rather than physically. So which is where I think the private guys do enjoy a business edge in the medium to longer term. In a very short term, let's say hypothetically, if in the budget government were to announce something favoring the public sector banks, given where the valuations are, you could see some rally because valuations and ownership levels both are low. So starting point is comfortable, economy is on the mend. But as I said, you'll need to see some of the external events to come in for those stocks to do well.
Yeah, I like that tone. Starting point is comfortable. Manish, I'll come back to you on the NBFCs in a bit as well. A couple of events lined up for the week too, so important to talk about that plus the earnings. But Rashi, can I take the moment to ask you about your thoughts on how do you expect the two spaces to do? The consensus seems to be that the earnings growth at least will be very, very strong from both cement and steel.
Yes, so steel should be fairly strong in the sense that, realizations are up by 4,000 to 5,000 rupees a ton, sorry, on a sequential basis. And some of it may get a little offset on the iron ore side wherever companies are not integrated, and then some maintenance expenses. That said, the EBITDA per ton expansion should be to the tune of about 3,000 to 4,000 rupees. But more than the earnings, I think the key point for steel to look at is one is that where we are on spot versus what is going to come through in the quarter, and spot is significantly higher, right? So when the earnings come through, they essentially set the base for what to expect going forward. And I do think there's a fair bit of comfort cushion on these realizations that exist at least for the next couple of months. The second thing is on the balance sheet, that the companies have obviously had very strong cash flows as a result of steel pricing. And second, they've all talked about cash management in the sense that they've, pushed the capex plan, and I'm not sure if anybody's expedited them yet, plus a lot of working capital management. So from the steel perspective, would really focus on what the balance sheets look like post this quarter and what it sets the tone again going forward. Likewise, on the cement side.
Sorry, Rashi, before we talk about cement, can I squeeze in a question?
Sure.
so what? So your answer, and please correct me if I'm wrong, but it seems to suggest that the near term seems to be finely placed, because I heard you say that what they deliver in quarter 3 could well be considered the base for the near term. And there's a probability, I don't know if I've missed it, if I've missed another price hike, but there could be a price hike now and maybe some other as well going ahead. Never mind what Nitin Gadkari had to say. So are you saying that would you believe that even if the Chinese data starts faltering a little bit, the domestic cues are strong enough for the sentiment and the earnings to look good for the current quarter for the steel companies?
Okay, so we've had a massive price increase through the month of December, like almost 5,000 rupees, 3 price increases apparently. We've had, I think, 2 price increases in the month of January. So when you compound those price increases, automatically the fourth quarter is going to show much higher realizations. Now, if for any reason Chinese data starts to falter, so for one, at the moment, Indian steel prices are actually still at a discount to import parity. Right, so we're not particularly worried about a little bit of correction here or there. There's probably some room for steel prices again to go up when I compare them to Japan prices, Korea prices, right? But if for any reason there is a correction in regional prices, we should, given the way demand is, or given the resilience that we are seeing, and we can also see that in how well iron ore prices are being absorbed, then I imagine that we will at least stay close to import parity. I don't expect there should be any sort of massive correction. The one data point that, now that you spoke about it, the one data point that we're watching or we're monitoring very closely is what happens to iron ore pricing. Because India has had an advantage given that a lot of producers have integrated iron ore. And second, for the non-integrated one also, iron ore prices are lower than import prices right now. So if, that's basically the risk that we are monitoring, both on the upside or on the downside. If, iron ore prices move down, then, we need to kind of keep a watch out.
Okay. So having said that then, if let's assume that the earnings delivery is as per what you estimate, Rashi, and the commentary is not too bad. I mean, I spoke to JSWC last month. They were very gung-ho about the better part of 2021 as well. So if the commentary is also looking robust, is there still juice left in the steel rally? The presumption that quarter 3 goes by without any event. We'll get to know this week, of course. Let's assume it goes past as you expect it to be.
Absolutely. So we do think that there is still some juice left. I mean, looking at a few things. One, like I mentioned, the leverage ratios will look attractive. Second, if you look at just pure valuations, even when I were to look at the price to book valuations, obviously we've come far from where trough levels have been. But, if you look at where valuations were, say, in early 2018, when we'd had like the last rally, the multiples are still much lower, and we are anticipating, or based on where spot prices are, the ROEs could possibly be at a 10-year high. So in that sense, maybe there's a little bit of, nervousness, like you mentioned at the beginning, another wave of the virus, this, that. But assuming all that doesn't really come to hurt, I do think that there is a fair bit of steam left. Specifically, this is a generic for the entire industry. But like if you look at a stock like Tata Steel, which is actually a top pick in the whole space, in addition to what I just mentioned, we do have a possible delta coming from the divestment of the Netherlands asset. Second is on the European business, the interesting point is that about 35% of their volumes are contracted annually, which happens in January, right? And the bulk of which is auto contracts. And clearly auto demand is very strong globally. So about 35% of their volumes have really not gotten repriced all through last year. So we will see a fair bit of their volumes getting repriced separate of what's going on to the monthly contracts as well.
Okay. I'll come back on cement, Rachi. Surendra, just one thing, because Rachi is talking about steel. Just squeeze in a question before I go to Arvind on some of these sectors which get impacted because of these rising commodity prices as well. And Arvind will probably talk about autos in a meaningful way. But non-autos, do you reckon that we haven't seen a significant margin squeeze because of commodity price inflation thus far? Do you reckon quarter 3, quarter 4 maybe could see signs of it in terms of commentary for some spaces?
Yeah, absolutely. So that's something which we have highlighted in the preview as well. So I think if you compare on a year-over-year basis, there is a meaningful inflation in some of these commodities, which will have an impact both on the performance and the commentary. And Arvind will talk about autos, but that's a clear example where you will see pressure, and I don't think the consumer sentiment is positive enough for companies to be able to pass the entire raw material increase. So definitely one of the risks that we would be monitoring as we go forward into the year.
Okay. Arvind, you want to jump in? Thanks for joining in. It's the first time that we're talking, so lovely having you. What's your sense? Because your space was bombed out. The biggest bombed out that I saw was in autos, right, for the April and June quarter. So there's a favorable base effect for the whole of 2021. But what about quarter three itself? Because they had to increase the prices from January, but December had no such luck. But there was festive season. So how do you juxtapose all of that for the quarter?
Yeah, thanks, Neeraj. So we've seen a strong volume growth in third quarter as well. In terms of commodity costs, they have started hitting, but I think the bulk of the commodity cost pressure would probably come in the fourth quarter. And that's why, as you said, companies have increased price in January. Though some companies did take sporadic price hikes even in October, but not to that extent. I think a couple of things which work well for earnings in third quarter. First is operating leverage is quite high. We understand there will be some bit of commodity pressures, but operating leverage is very high. So that kind of offsets the impact at the margin level. Secondly, companies, once COVID started and April we had zero sales, companies have been cutting down significantly on some of the fixed costs. Some of them probably could come back, but some of them would stay. For example, cuts in marketing costs, cuts in travel costs. So those things would help in the margins, at least in the third quarter. Now, what is very important in terms of the commentary is first, definitely, how does demand sustain? As Surendra said, consumer sentiments are only to a certain level. You can't increase prices so massively, especially because the increase in commodity costs, especially steel or the precious group metals, has been quite high. So a lot of commentary around the demand, the sustainability of the demand more than revival. We've seen the revival, but does it sustain through? And is it good enough for increasing prices? That is where the commentary would be centered around. In terms of the quarter per se, we think it should be a fairly good quarter. We know the volumes upfront. So with auto, that's a good part. We know the volumes upfront. But I think how the companies manage their costs and the extent of operating leverage would probably decide on the margins.
So let me start with the smaller pocket first, Arvind. Tractors and the conversation with escorts seem to suggest that things are looking, for lack of a better term, hunky-dory for the quarter gone by, for the outlook ahead. So how do you place the tractor companies?
Right. So we have a buy on Mahindra as one of our preferred picks. I think tractors have had a very good year. The agriculture aspect was outside the ambit of the lockdown. So they didn't go down as much as the worst was of the commercial vehicles or even passenger vehicles and two-wheelers. So tractors were good that way. Secondly, we've had good monsoons. Last year's Rabi crop was good. This year's Kharif crop has been good. Even the next sowing appears to be good. So all these things augur well for overall rural demand. So we believe tractor demand should persist for some time. Obviously, what happens in the monsoons next year is difficult to foresee. But as of now, how this year's monsoons have been, the crop sowing and harvest, we believe that we are still positive on the tractors front, and we have a positive stance on Mahindra and Mahindra.
Okay. What about two-wheelers, Arvind? Where do you expect good report card of numbers / margins, and maybe combine that with good commentary as well? Which of the 3 or 4 or 5 companies do you expect can do really well?
So surprisingly, this time the disparity between two-wheelers and passenger vehicles has been slightly on the higher side. Most of the time they do move in tandem. Last year both of them grew by almost 18%. So two-wheeler companies have been doing better. Festive season was a very strong commentary. But in December, things have gone down slightly, versus October, November. So we'll have to see what's the commentary around inventory levels. Was it an year-end impact, or the demand has taken a bit of a downturn? That we'll have to see, because 1 month we could have some inventory correction as well. In terms of the company specifics, we like both Hero and Eicher. Hero again is a rural theme. They have done very well. In the premium bike market, where they were almost absent, they have made good foray. For Eicher Motors, I think there was question or skepticism about their new model doing good, but the new model launch has had a fairly good response. So yes, we are positive on that. In the passenger vehicle segment, Maruti remains our top pick. I think the segment has done well. You could say it's also because of new models by competitors, and even for Maruti itself, their Brezza seems to be doing quite well, even in the petrol avatar. So yes, passenger vehicles and two-wheelers have both been doing well. That said, passenger vehicles has been slightly better off than the two-wheeler segment.
Okay, thanks for that, Arvind. Surendra, can I come to you for IT, which is the other one that we haven't discussed, the big one? A large portion of earnings are out, some mid caps lined up this week. What did you make of the report, Raj? Because I thought most companies did slightly better than what the expectations were from them. What's your sense?
Yeah, so I think it was a kind of mixed on a couple of things. Obviously, the results were good. So clearly, the demand, at least from a short-term project perspective, seems to be strong. And secondly, the deal flow, anyway, some of these companies had announced large deals. So the expectation was that they would report a good deal flow, which also by and large played out. Okay. But at the same time, if you look at the fourth quarter guidance for companies who guide, like Infosys, there is an implied guidance, HCL Tech guides, Wipro guides, it does look more like a normal year. And which is where I think the street is getting a little worried that is it that whatever we saw in the last, say, 6 months was more like some kind of a pent up because the June quarter was quite weak. So there was some reversal, and are we normalizing? So I think that's a question which will get answered as we go forward into the next couple of quarters. Because I think from a IT perspective, the question which is most important is FY23 a big growth year, or is it a more like a normal growth year? Because FY22 will obviously benefit from a low base and pent up and so on. And I think that question will take maybe a couple of quarters, 3 quarters to get answered. We are still of the belief that FY23 we at least normalize to a large extent. So FY22 you could see good growth, like there will be companies 13, 14, 15% growth. But then we go back to 9, 10% kind of a growth as we go forward in FY23, and that is where the big debate is about. So I would say this quarter, by and large, was strong, but I think the fourth quarter guidance has left a little bit of a doubt in investors' mind.
So which company, Surendra, just one more question on IT, which company disappointed you in terms of PAT post quarter 3, because a large portion of earnings are done? And where is it that there is some bit of comfort, either due to commentary or due to valuations or due to a combination of both?
Yeah. So I think the 3 companies which guided, right? If you look at Infosys, HCL, and Wipro, all of them kind of are guiding for almost like a normal seasonality fourth quarter, right? So the beat which you saw in Q2 and Q3 is at least missing in the guidance. Now, some of that could be conservative, and you could actually see things better because at this point, I think companies will be cautious because usually the March quarter is slow. Okay, so that's one thing to keep in mind. Now, what we would really be positive on is where we have visibility, and it's not about one quarter. We are looking at it clearly from a 12-month out perspective, right? And when you look at the Infosys with $7 billion of deal flow in one quarter, right? Or if you are looking at trailing 12 months, which is how I look at the order book, it is up 50% plus over the prior 12 months. That's a very, very strong visibility, and I would be very positive on that kind of visibility, particularly given, interestingly, the stock has pulled back a little, which makes the multiples even more easier to justify. So I think best visibility is on Infosys. We like that name. HCL Tech is decent visibility. Okay, they are continuing to execute well. Okay, and the positive surprise was actually on the software side, where they delivered a high single-digit growth, and that's a business which in most people's minds is a declining business. And yet you are getting the stock at roughly 18 and a half times earnings, FY22. We're not talking about FY23. So HCL Tech looks good, and Tech Mahindra similarly valuations, and we are entering the 5G cycle. You will see a lot more deal flow. So those are 3 stocks where we would be positive on at this juncture.
Okay, just one quick round of questions, gentlemen, before and all of you rather. Please excuse me, Rashi. I don't know, I'm stuck on this gentleman thing, but yeah, just one quick last round of questions before we call it a day. Manish, come to you first on NBFCs as well. We have the biggie coming out this week, and then the RBI governor also hinted at the set of regulations being put out. So that's not earnings related, but just combining the two. What's your sense on Q3 for NBFCs? And I mean, if you have a thought on what would you watch out for when it comes to Bajaj Finance, because after HDB Financial's performance, and I'm not comparing the two, Bajaj Finance will obviously do much better, but still your thoughts.
Yeah, so I mean, if you take HDB as a reference point, investors would want to benchmark the shift or let's say the movement in bank asset quality trends vis-a-vis NBFC asset quality trends. Obviously, because NBFCs in some sense cater to, let's say, a couple of segments below banks, asset quality is likely to be weaker, but market will react to the delta. So banks have moved from A to B. How do NBFCs move is what something needs to be watched out for. And unfortunately, HDB doesn't give that much of confidence. Let's see. Bajaj, like with HDFC Bank, as far as asset quality goes, probably would do better than peers. Although in terms of growth, they did the pre-quarter release. Growth was in some sense softer than what one would have expected going into the quarter. So the key variable really at the moment is asset quality, and the delta there is what really matters. On regulations, honestly, it's a very tough job. I mean, it's tougher than predicting earnings to expect what regulators will do. But our sense is they would probably tighten governance and risk management framework first, before, if at all, going towards, let's say, CRR or SLR or equivalent, which is what some of the market participants are fearing. Even a couple of large NBFCs which have failed in the last 3 years, I think governance practices and risk management framework is where the RBI would initially focus on. Because if they do bring in anything like CRR or SLR, they would probably also tie in with the conversion to bank phenomenon. I mean, you can't have one and not have the other. So directionally, we will go there. But thankfully, in the past, whenever RBI has made some meaningful change in regulations, they've always given enough time for entities to comply. Right? When NBFCs moved from 180 to 90 days, they were given almost 3.5 years. So whatever be the regulatory change, I'm sure there will be enough and more time given for the participants to adjust towards it.
Okay. Thanks for that, Manish. Rashid, cement, the other space which is expected to do well, what are you watching out for, and what's the pecking order, if you will, based on? I mean, are you basing it on the earnings? Because I saw two reports in even yours. The expectation is that barring one or two, most companies would actually have a fairly healthy reportage of Q3 profit.
So on cement, unlike steel, so realizations we're expecting should be down on a sequential basis. On a year-on-year basis, up, depending on which company, what region we're talking about, but, to as low as 2% to higher as well. The key to watch out on cement is the cost side, right? Because the first 2 quarters, the companies have really done a good job managing costs. A lot of the spend has not come back, as we discussed, earlier. And the second thing is how they're managing the whole petcoke price increase. So we understand that there's a lot of substitution that's happened with thermal coal, some old inventories also there. Plus, companies are working a lot on the energy efficiency initiatives. That apart, specific to ACC and Ambuja, their master supplier agreement also seems to be benefiting them over the last few quarters. And we want to see how that kind of pans out. So from an earnings perspective, I think the key that we're watching out for right away is how they're managing costs now and what is the commentary going forward, right? Because some of the spend in terms of advertising, etc., I imagine would start coming back again. Second, globally, thermal coal prices have also started moving up. So how they would kind of balance out the petcoke versus the whole thermal coal mix, as we move ahead. And this is particularly important given that we haven't really seen any, price increases happen in the last few months. So that commentary, and I think then that also kind of leads us to kind of figure out as to what is the extent of price increases one can anticipate going forward. And I would imagine that may happen more into the next fiscal because March would be a year end and companies would want to push volumes as well. So that's what we'd be looking at this point, the cost side more.
And which ones do you like the most? What's the pecking order based on earnings growth?
Yeah, so based on so our pecking order right now is, so our top picks have been ACC and Ultratech, and Ultratech has had a pretty decent run. So at this point in time, when you look at the clear comfort on valuations, I mean, in our coverage, there are 2 stocks which are at replacement cost or at about replacement cost. One is ACC and the second is Dalmia. Now, Dalmia more for concerns, on the mutual funds, etc. So at this point in time, I think the most comfort would be on ACC.
Both the stocks have come off a bit in the last 2-3 days as well. Yeah. Thanks so much for that, Rashid. Arvind, just one quick final question to you before I take the wrap-out question from Surendra, and that's on CVs, right? Would CVs be the lead indicator for economic revival or the lag indicator? And do you reckon that the next 12 months could see a disproportionately strong earnings growth from them? And therefore, do you like any of the CV players?
Sure, yes. In fact, we like Ashok Leyland. We actually think in third quarter they could surprise on the positive because of the kind of the operating leverage. So in CVs, if you see the heavy commercial vehicles or the goods MHCVs, they are due for an upcycle now. It should have happened earlier, but we had the BS4 to 6 transition and we had COVID. So they are due for an upcycle now. I think YOY naturally next 3 quarters are going to be extremely high because the base is very weak in the heavy commercial vehicles. That's one thing, but as rightly, they are the best indicator of an industry and infrastructure recovery. So we've seen in the past, because of COVID, because of cash crunch, capex has been a bit low. We expect that to revive. As and when that revives, heavy commercial vehicles do benefit a lot. So that's one thing which we are going to see a strong uptake, and that's why we are very positive on Ashok Leyland. In the light commercial vehicle or the LCV segment, things haven't been that bad. They have been pretty steady thanks to e-commerce or last mile connectivity or rural connectivity. Therefore, they have been steadier than the heavy commercial vehicles. Therefore, that YOY growth might not be that strong. But nevertheless, again, coming back to Ashok Leyland, they have made a big foray into the LCV segment with the new model. So they kind of benefit. So that's one company to look out for in CV cycle recovery.
Okay, thanks, Arvind, for that. Surendra, final question, and non-earnings of sorts, but still, the 2021 seems to be the year wherein we could see the advent of the tech-enabled niche businesses which have been missing in the Indian landscape. Nazara is filed for the IPO, and I reckon we'll see the Zomatos, Flipkarts, etc. of the world coming in as well. Looking forward to it.
Yeah, absolutely. So if you look at one of the things about the Indian market is there are not really that many players on the new tech space. So I think it will be great to have some of these companies really come through, and it's a good time because what has happened is COVID in some ways was a big inflection point for a lot of these businesses, right? I think both in terms of the penetration and acceptance as well as the ability to monetize, right? Because when people were kind of forced to use and habits change, so I think we are at a very interesting juncture, and yeah, absolutely hopeful that a year or 2 years from now, when we talk about it, we'll have a large space to talk about a number of choices to make on the new tech space in India.
Cross fingers for that. All of you, Rashi and the three gentlemen, thank you so much for joining in today and giving us your thoughts. Really appreciate your time.
Thank you.
Thank you.
And viewers, thanks for tuning into this conversation.